a lot of times when we talk to investors or our partners and we throw out the idea of 10 years and it's, oh my God, 10 years, but 10 years goes by so fast in real estate. And then the compounding of appreciation in general, but also in our area with the growth that we have here, it is amazing. I mean, the project that we talked about earlier today that we're working on in the Opportunity Zone, we know that we put all of our money on the fact that this location in 10 years is going to be in the heart of it, with the way the growth pattern is. And we feel real comfortable investing and we'd prefer setting it up over a 10-year period, especially in a situation like this where, one, we're not paying any capital gain on the appreciation, but also harping back to what we talked about before, the depreciation is never paid back. And that is just this secret little, it's my favorite part of the Opportunity Zones because as a function, you're investing so much into the property, which typically means there's a lot of, if it's an existing asset and you're just repurposing it and doing an adaptive reuse, well, you're putting a lot of personal property into it. And if it's ground up by nature, there's going to be that as well. So no matter how you go about it, there's always going to be a pretty good element of personal property, which leads to that bonus depreciation that you're able to recapture on the front end, which can also help defer some of those costs on paying back the cap gain.
And this is where I think it comes into good planning too. Just because you have that gain hitting in 2026, if you can put another asset into service in that same year, you can offset some of this gain that you had to recognize from this cap gains. So, and to clarify, it's not a mandatory 10-year hold. If somebody comes along and offers you a price you cannot turn down, you can sell that asset. You're just gonna have to realize the gain, but in theory can 1031 within the fund. So there's some strategies at play within the OZ. So it's not the ideal situation, yes, is a hold 10 years and not pay any tax, but there are some options.
Yeah, there's a little flexibility in there to move into a new asset. You have a little bit of time, but and we've talked about that, and that's also one of our strategies. If the price is right and we get an offer, we'd like to be able to execute on it if we can and not lose any of the benefit.
That's right.
And so we've seen some creative ways of going about that as well. Yeah.
Vincenzo, I think I want to reiterate that that depreciation. You almost get the best of both worlds. I think people in real estate, for a lot of time, that depreciation has led, and the tax-free refinance out has led to, I have a big negative capital account. So a lot of times upon sale, you have this phantom income. I have more taxable gain than I do cash coming out. And with these OZ funds, what we have is the OZ rules, and then we have the partnership rules. And what's interesting is that part of, do I have to recapture that depreciation or don't I, falls back into the partnership laws, not the OZ rules. And so that's why we see a lot of times the OZ fund is a single asset. Because in order to get that depreciation recapture gone away, is the fund has to sell the partnership interest, not the asset within the QOZB. And will that change? It almost seems too good to be true that I get the benefit of the tax write-off of that depreciation, but when I sell it after 10 years, I don't pay tax on the appreciation or recapture the depreciation. But the benefit we have is that's not an OZ rule, it's a partnership rule. But if you did have one fund with 3 assets, it's going to be harder to sell the fund. You may have to sell each asset. You still, in that case, get the benefit of the appreciation as tax-free, but you will have to recapture the depreciation. So it's very important in how can we get these set up properly from the beginning.